Hey everyone, me Kevin here. So the Federal Reserve just spoke and basically crashed the market again. That V-shaped crash we had this morning basically got revisited in certain stocks like Tesla. Not in all. We didn't hit the sharp bottoms that we did this morning, but we definitely hit some lows after Mr. Powell decided to talk today. Why? Why would this happen? Well, the easiest thing to do is explain what Jerome Powell said, add some insight into what Jerome Powell was saying, and then go into what he didn't say, which is causing some pain in the market. So here we go. First, Jerome Powell started off by talking about inflation, and this is a big thing. Jerome Powell drills this into the market, but the market doesn't care. Jerome Powell consistently tells us that it is unlikely that, quote, deeply ingrained inflation expectations will change. What this means is we have had inflation declining for decades. Since the 80s, inflation has been going down. We expect things to get cheaper with technology, not more expensive. In time, we have been in this deflationary cycle, much like the Eurozone, which is even worse off than we are. And Jerome Powell believes, look, we're going to see these short-term spikes. And there are two reasons we're going to see short-term spikes. One, we're going to see them because of something called base effects. In English, that means in March, when we look at the inflation readings, the CPI readings in March, they're going to be way higher than they were in March of last year because inflation was in the toilet last year because everybody's cutting prices because nobody was buying anything, right? We had this sudden deflation March, April, and May of last year because of the pandemic. And so when we compare year over year, it's going to look like, oh my gosh, we've got 3% inflation, 3.5% inflation. Jerome's like, dude, that's not going to matter. Like that is not real inflation. That doesn't matter. So ignore that. He's making this crystal clear. He says the same thing over and over again. He's basically begging the market, like trying to grab people by the neck going, we're not seeing inflation. That's basically what Jerome Powell is doing while at the same time money printing. So it's kind of like he's grabbing your neck with one hand. There's no inflation, okay, while running the money printer. So the market doesn't believe him because he's running the money printer, right? Now, Jerome Powell says that there's a second reason we could see inflation, and that's just the economy reopening again. People go on vacations again, traveling again, spending money again. That'll create a short-term spike in inflation. But the big thing that he says here is it is unlikely that, and he really added inflection on a lot of his words today, deeply ingrained inflation expectations will change. Jerome Powell believes that inflation only goes up when people expect prices to go up. So for example, let's say a cup of coffee is $1. If we expect this cup of coffee will be $1, $1.03 next year, and then $1.06 thereafter, and $1.09 and I don't know, some change thereafter, then we expect inflation to come. But most of us don't expect that. We actually expect the cup of coffee to maybe go to like $1.01, maybe $1.02, right? Like we don't actually as a society tend to believe that there's going to be massive inflation. However, the money printing is what's creating this bizarreness. Like if you ask people, a few years ago, when are we going to see big inflation? Most inflation wasn't that big of a concern. Inflation really only became a big concern because of the money printing that's happening now. And it's possible that Jerome is wrong, and that's the bet the market is making. The market is betting money that Jerome is wrong. The velocity of money is going to go up. The amount of time money circulates through the economy is going to increase, which means prices will go up because so much money is going to be chasing a limited supply of goods. Supply demand says then prices go up. But Jerome is saying, okay, fine, maybe that'll happen at the reopening, but that's not going to stay consistent. We're not consistently going to see those pressures. And so when he's asked, is the market wrong on inflation? He says, look, we're watching the bond market. We saw what happened in the bond market last week, basically the spike of the 10-year to 1.5 and that acceleration in the bond yields going up. He noticed that. He says he paid attention to that. But he says, look, despite what happened, we're a long way from our goals. We would be concerned if the markets were actually starting to fail or if there were a tightening of financial conditions at banks like, oh, we don't want to lend anymore. Let's start freezing credit lines and stuff. He says that's when I would be concerned. But markets, hey, they think rates are going to go up sooner. We don't think so, is what Fed Chair Jerome Powell is saying. And I'll explain why then the market is crashing, because there's a reason for that. Now, then he says, what would it take to then raise rates? And he says, look, it's going to take substantial progress for some time. When he uses the word sometime, usually he's referring, in my opinion, to 6 to 18 months of progress. In fact, he kind of laughed about the fact that, I mean, he didn't laugh about this because it's not laughable, but he's kind of like, look, we just had 3 months of no progress, is what he's saying, in the labor market. Like, we need substantial progress for some time. And we just had 3 months of no progress. Like, Jerome Powell, like, if I could, like, really simplify what Jerome Powell feels right now, he's like, how effing clear can I make it? We're not having any progress. Why are you assuming there's progress? There has been no progress. We see no progress. We think the progress you think is going to come is going to be temporary and fleeting. Like Jerome Powell on the inside, I think he's freaking out. I think he goes home to his wife and he's like, these people don't get it. Like I keep saying, there's not going to be inflation. I keep saying we're nowhere close to a recovery. And here's the market thinking, no, Jerome's lying. The rates are going to go up soon. I think that's what's in his head. Like, I sincerely think he goes home and he's extremely frustrated. And that's why when he's on these interviews, he says things like, we're trying to get to sustain 2% inflation and run moderately above that. We're trying to get to maximum employment, which maximum employment doesn't just mean 4% unemployment as a rate. It means that blacks, whites, Hispanics, women, people of all races and colors are fully employed. That's maximum employment, and that's very important. He says we are, quote, a very long way away from that. And that there's a lot of recovery that still needs to happen. We're not going to raise rates until we see these conditions fulfilled. And he calls these conditions very desirable, aka it's like he's going, dude, it's a long way out. He says inflation expectations are expected to be transitory. And he even gets frustrated during the interview. During the interview, he says, there's a lot of ground to cover. I'm trying to make it as clear as possible. The problem is Jerome Powell is stuck with all the big words, and he just needs to simplify and go, y'all, look, it's simple. We ain't got inflation coming, solid inflation coming, for probably 4 years. So shut the F up, sit down, keep buying your stonks. We're going to keep running the money printer and stop freaking out because you're freaking out for no reason. Now, whether we believe him or not, that's the different thing. And clearly the market doesn't believe him. So, and I'm going to talk in just a moment about why would the market go down while he was talking. But I quickly want to finish, make sure I got everything here. Presumably, the next couple months we'll see some growth, but we'll want substantial further progress. So he's already discounting the fact that we're going to see some growth in the next few months. And he's basically saying, like, it's going to take some time beyond that to actually see growth. In terms of when, he doesn't speculate on that. There's no formula. It's really just whenever Jerome Powell feels like we've hit substantial growth. There's no steadfast formula, and I think that's why people are frustrated, because it's like, it's confusing. Because again, it's he's holding you by the neck, choking you, going, there's no inflation, but he's running the money printer and billions of dollars are spewing into the economy every month, right? So it's like mixed messages, and this is why people have a hard time believing what he says. But he is in a very, like, he's concealing his emotion, but you know he's really frustrated on the inside. Okay, so why would the market sell off while he's talking? Not all stocks sold off to the lows that we saw earlier, with the exception of Tesla. Tesla literally just right now looks like it hit a new low. I actually just bought a little bit more Tesla. And as always, I send alerts of all my buys and sells to those of you in the Stocks and Psychology Money Group. But why would the market sell off after his talk? I mean, he's basically saying all the right things, right? So why would the market sell off? Okay, here's the answer. The market is selling off after Jerome Powell spoke because the market expected. There were rumors circulating about this last night, a lot of rumors about this last night. There were rumors that Jerome Powell and the Fed were going to come out this morning before the pre-market or potentially during his talk just now. And he was going to come out and go, you know what? We see the stress in the bond market. We are going to extend the standard liquidity ratio at banks, which expires on March 31st. And that is going to, in English, we're going to make it so that banks have more cash available and they can go buy bonds, which if they buy bonds, that'll drive yields down. Jerome did not do that. That is why Jerome crashed the market today, because Jerome doubled down on his old talk, which we already know about, but did not do what the market was expecting, which this deadline is coming up on March 31st. It's called the SLR. standard liquidity ratio, something like that. And basically it says banks need to keep a certain percentage of cash on their books. But that was eliminated during the pandemic for 1 year. So it was kind of like March, in March they eliminated this liquidity reserves ratio and they extended it, and this was going to last for a year. That expiration comes up at the end of the month. There's a rumor that the reason bond yields are going up is because banks aren't able to buy because they're trying to come up with enough money to make sure they can meet the rules that are coming around at the end of the month. Now, banks haven't really been massive buyers of bonds, so I don't know. I think they're like 5% buyers of bonds or whatever. So I don't know how, oh, thank you. Supplementary leverage ratio, whatever. Thank you. Appreciate the clarification though. So in case you want to look it up, the SLR. That's the technical name for it, but it's the same thing. And so basically, the rumor was that, okay, the Fed was going to see this tension in the bond market and come out and say, all right, it's all good. We're going to come in. We're going to come save the day. And basically, we're just going to make it so that banks, y'all good. You know what? Have another 6 months of not needing to have all that money on standby, in your bank. Go ahead. Have another 6 months. You guys want to go shopping for some bonds? Go ahead. And that the rumor was that was going to create some demand for bonds. Now, during the conversation that Jerome had here, bond yields shot up, actually substantially. I mean, we just hit higher bond yields than what we had, looks like last week. Oh, yeah. We just hit, look at this. Or at least we're matching the levels we had before. That is crazy. Let's maximize this. Let me see if I can quickly draw on this. Oh, I can. Oh, that's really cool. See, right here, that was last Tuesday and Thursday, I believe was here. This was Thursday. This was Tuesday. And look at this disaster Jerome Powell caused here. And it's not really Jerome's fault, just because some people had a rumor that the Fed was going to act and do something today. Now the Fed didn't, and the market's like, well, fine then. F you. and so this is why we're seeing some more of this pain in the market right now. So did the Fed crash the market? Yeah. Basically, the Fed just crashed the market again. So I'll be back for a market closing live stream. Thank you so very much for watching as usual. Make sure to get yourself 2 free stocks with Webull because you need it at this point. Go to mettkevin.com/Webull, sign up, deposit $100. You get 2 free stocks worth up to $1,850. Use that coupon code, join the Stocks and Psychology of Money group. Folks, we will see you in the next one. Appreciate you. Bye.